Okay, let's move on to other cases. Now, we talked about issuance at par, issuance above par value. Some of the companies, sometimes when they issue stock, they're allowed to not set any par value at all. Okay, so this also happens. Nowadays, some of the companies, they do have a par value set for their each and every share that they issue to the public. Some of the state, they give the company the option to choose whether or not they want to set a face value or not. Okay, so for these companies, then whatever is the issue price, whatever is the market price of the stock at the time they issue it, altogether goes into common stock account. Okay, meaning for these companies, with the case that they don't have a face value set while they incorporated the business, then they don't have the paid-in capital in excess account. Okay, so these two accounts, the premium accounts, only exist if company's stock has a face value. So whether or not they do have one, that depends on each and every state's regulation. Okay, so some cases, if the problem tells you the company issues no par stock, that basically makes the case easier because there's no premium to consider. Whatever is the issue price, that's the price that you times the number of shares you collect the cash for. That's also the price that you record common stock for. Okay, so there are two examples here. If January 1st they issue stock at the time the market price is $1 per share, then the journal transaction will look like this. We would debit cash, credit common stock by the number of shares times market price $1. Well, let's say the following day they issue additional $1 million of shares, and now market price boosts up to $20, for example. In this case, when you journalize entry, again, it's just cash and credit common stock, just the dollar amount that they receive, the market price. Okay, because there's nothing to compare against. When we use the paid-in capital, the premium account, we were comparing market price and face value. But for this case, if the company doesn't have a set face value, then there's nothing to compare against. Everything goes into common stock account. Okay, so this is a case for no par value stock, no face value sets in the beginning when a company started. Some of the states allows companies to not set a par value. So in these cases, the legal capital amount, since there's no face value, legal capital would be whatever is the first journal entry, first issuance of stock to the public. If the first one is the first journal entry when the business started, then that $1 million will be the legal capital. Just the initial transaction, initial stock issuance entry. Okay, so we talked about par value stock, no par value stock. For no par value stock under balance sheet, you would only see common stock under paid-in capital account. Again, you won't see those premium accounts. Okay, so just a reminder. You would see common stock or preferred stock, but no excess amount of T accounts listed.